Welcome, Benzinga Nation. Today I have Jay Hatfield, who is a CIO of SCAP ETF, ticker SCAP. Jay, thank you so much for joining me.
Thanks for having me, Zunaid.
Absolutely. If you could kind of give us a quick, brief overview of the infrastructure capital.
Yeah, so we are a firm that focuses on income investing. And so we have 5 different funds. 2 are fixed income funds, or preferred, they happen to be in preferred stocks. And 3 are equity income funds. 1 is an MLPs, and then 2 others are both large cap dividend fund, ICAP, and then a small cap dividend fund, SCAP.
And what do you believe kind of brings the most success over time, right? What's the philosophy that drives the funds here?
We invest, well, on the credit side, we always look for really good coverage of the preferred slice of the capital structure, as well as coverage of the payments, the dividend payments. And we look for hard assets. That's why our firm is called Infrastructure Capital. So we look for utilities, REITs. Those are always good credits, almost always good credits, MLPs, pipelines. And then on the income side, there is some infrastructure, or a lot of infrastructure, but we also look for companies that have good coverage of dividends, are retaining earnings, investing them at attractive rates. And so you're likely to get either better dividend coverage, or in most cases, increasing dividends and better dividend coverage.
And so much of like someone's background kind of really helps the vision of a company, in this case, an ETF. You talked about the dividends aspect of it. What vision are you bringing in as a CIO, and how does your background kind of help inform your decisions here?
Well, I started my career after graduating from Wharton with an MBA in the utility sector. So I covered utilities for Morgan Stanley on the investment banking side. And that's when I learned, like, these are really great investments, particularly for people who want more stability, who might be closer to retirement, or just more conservative, because in that case of utilities, are pretty extreme. It's regulated. And then I also was an MLP, or pipeline investment banker, and then, branched into doing REITs and running income portfolios for hedge funds, Steve Cohen. And then we launched our ETFs based on that investing style, more asset-based, always having income, more conservative investment.
So why be a bit more conservative, right? There are many different options that you could have gone. Why focus on the areas that you've chosen to?
Well, I think that everybody, really, even on your own, can go buy a reasonable portfolio of tech stocks. I mean, in fact, you get them whether you like it or not. If you buy the S&P, you get 40% tech stocks. You can buy the Qs, you get 100%. Yeah. You can buy your favorite names because you know them, because you have an iPhone, or you're a gamer and have NVIDIA chips. So everybody kind of likes to do that on their own. But to do the work we do, particularly on the preferred stock side, just takes a tremendous amount of work. There's a lot of economies of scale. So we thought it was more value added to investors to really curate the income side of it versus the growth.
That makes perfect sense. You mentioned the gaming. I'm looking at my controller and my iPhone, so I fit that category there. The markets have, in different sectors, have been hitting all-time highs, whether it's on the Bitcoin side, gold. You also obviously have the stock market itself that hit all-time highs this year. What is your view on the health of the current market?
Well, I was on another channel this morning, and the announcer verified what we'd already suspected, which is we're really the highest target out there for the S&P. We have 5750, and we believe the risk is the upside. And what we're focused on that's different, although, by the way, the market seems to agree with us. It's always good to be a market whisperer, like, in other words, listen to what the market's telling you. This market wants to go higher, believe me. It's a bad short, is what we'd say in a hedge fund. But the key that we're focused on that most aren't is there's going to be not just the Fed cutting rates, but it's going to be a global rate cut. And on our website, we publish the global monetary base. And if you just follow the global monetary base, in other words, when it's growing, you are very long. And when it's declining, you were short or out of the market. You would do extraordinarily well. And we're forecasting a $2 trillion increase in the money supply. So that's money being injected by central banks into the banking system.
Yeah.
It then flows into stocks and bonds. So, and also, of course, we recognize the AI boom is real. If you look at NVIDIA's last call, very broad-based demand. And then typically markets in emerging technology get overvalued. And most of the stocks we look at are either a little bit undervalued, like NVIDIA, we have a $1,000 target, or fairly valued, but it's not like NVIDIA is trading at 2,000. So we think there's a lot of upside in that market, and that's efficient because it attracts capital for investment in emerging technologies. That's why the U.S. leads the world in technology.
You brought up the Fed earlier in the conversation, so let me kind of close it out with that. When do you expect the Fed to cut rates, and by how much?
Well, we're actually a little bit more conservative than the market on that. We don't think the Fed will cut rates until July, when the market has a 70% probability of June. The reason for that is just that the data is distorted on PC core, and the Fed's very rigid in their methodology. But the reason we can remain bullish is that the ECB de facto announced they're cutting in June. They're just as important as the Fed is. And it is a global capital market, not so much on stocks, but on bonds, on sovereign bonds. So that should get rates rallying, bonds rallying and rates declining, which will be a fuel for a powerful summer rally. So we're focused on central banks broadly, not just the Fed.
Yeah, it makes sense. And whatever happens in bonds obviously impacts the stock market as well. But I appreciate your time. Thank you so much for joining us.
Thanks, Sinead.
Absolutely. That is Jay Hatfield, who's the CIO of SCAP ETF, ticker SCAP.